Imagine a scenario where the wealthy are being targeted by new taxes on their vacation properties, and this trend is gaining traction across various states. This is not just a financial issue. It's a matter of community impact and economic vitality. But here's where it gets controversial. These taxes, while aimed at the affluent, could inadvertently harm local economies that rely on their spending. Recently, states like Rhode Island and Montana have initiated tax increases on luxury second homes, igniting a wave of discontent among real estate agents and potential buyers. They argue that these taxes unfairly penalize individuals who significantly contribute to local economies. For instance, Rhode Island has introduced a new tax, informally dubbed the Taylor Swift tax, after the pop star who purchased a beach house in the upscale Watch Hill area back in 2013. This tax imposes an additional charge on second homes valued over $1 million. Specifically, for properties that are not primary residences and are occupied for less than 182 days a year, the state will levy a fee of $2.50 for every $500 of assessed value exceeding the first million. This surcharge is in addition to existing property taxes, leading to substantial increases for luxury homes in affluent areas like Newport and Watch Hill. To illustrate, Swift's property, valued at approximately $28 million, currently incurs annual property taxes of around $201,000. With the new tax, her total tax burden could rise to about $337,442 annually, despite her infrequent visits. Real estate professionals argue that this tax hike targets those who already contribute significantly to the local tax base. Wealthy second home owners often pay high property taxes but utilize fewer local services. As their primary residences are located in cities like New York or Boston, their children typically do not attend local schools and they rarely require municipal services, as they only spend a few months each year in these communities. These individuals come here for the summer, spend their money, and pay their fair share of taxes, remarked Donna Kruger-Simmons, a sales agent with Mott Chase Sotheby's International Realty. They are being penalized simply because they have another home elsewhere. Local business owners and real estate agents emphasize that these seasonal residents are crucial to the economic health of towns like Newport and Watch Hill. "You're just hurting the people who support small businesses," said Lori Joyle from Leela Gelman Compass. "You're driving away those who contribute the most to the local economy." In addition to the new surcharge, Rhode Island is also increasing its conveyance tax on luxury real estate starting in October. This tax will add an extra $3.75 for every $500 on real estate transactions exceeding $800,000. Furthermore, the state's high estate tax is discouraging many ultra-wealthy individuals from making Rhode Island their primary residence. As a result of these tax increases, some second home owners are contemplating selling their properties, while potential buyers are hesitating to make purchases. Although the tax hikes may not lead to a mass exodus of wealthy individuals, Joyle noted that many prospective buyers are exploring coastal towns in Connecticut as alternatives, where they can find beautiful locations without the burden of such high taxes. At the end of the day, it's about how they choose to spend their discretionary income, she explained. Montana is experiencing a similar situation. The state has implemented a two-tier property tax system that raises taxes on second homes and short-term rentals, while lowering rates for full-time residents. This change comes in response to the influx of affluent newcomers during the pandemic, which has driven up home prices and sparked resentment over gentrification. The new tax structure will increase taxes on second homes by an average of 68%. Prompting some buyers to delay their decisions until they see the impact of these changes. Valerie Johnson, a real estate agent in Bozeman, Montana, pointed out that while the tax is marketed as a measure targeting wealthy second homeowners, it will also affect longtime locals who rely on rental properties for income. For many, these are small businesses, she noted. Manish Bhatt, a senior policy analyst at the Tax Foundation, cautioned that while taxing wealthy second homeowners may seem politically appealing, it often leads to inefficient tax policies. He argues that property tax reform should be comprehensive rather than singling out specific groups. There is a rush to find revenue right now, he stated. However, taxing second homeowners could backfire, discouraging them from owning properties in those communities. While the new taxes may not immediately drive wealthy individuals away, Bott warns that taxes play a significant role in the decisions of both businesses and individuals, potentially leading them to consider purchasing properties in neighboring states with lower tax burdens. Interestingly, the anticipated revenue from these new taxes may not meet expectations. For example, when Los Angeles introduced its mansion tax in 2022, projections estimated annual revenues between $600 million and $1.1 billion. However, after more than 2 years, the tax has only generated $785 million, a shortfall attributed in part to higher interest rates that have negatively impacted the housing market. Michael Manville, a professor of urban planning at UCLA, noted that the tax has also led to a decrease in transactions among wealthy buyers and sellers. The lower revenue is concerning because it suggests that the tax might actually be reducing transactions, which could, in turn, lower housing production and property tax revenue, he explained. As these tax policies evolve, they raise important questions about the balance between generating revenue and maintaining a thriving local economy. Are these measures truly beneficial for communities, or do they risk alienating the very individuals who help sustain them? We invite you to share your thoughts in the comments below. Do you agree with the approach taken by these states, or do you believe it could have unintended consequences?